Hi everyone and welcome to a brand new episode. My name is Marcus and today we're looking at Unilever, and this stock is requested by AO. Thank you so much AO for reaching out, commenting and requesting the video. I hope you will be watching. I hope you guys will enjoy this episode, and if you have any questions or have stocks you want me to do a video on, please let me know. So we will cover the income statement, balance sheet, cash flow, key figures, our key feature and a technical aspect of the stock. Now, should we be buying the stock? Well, let's find out. So Unilever is traded on New York Stock Exchange and are in the life science sector. If we go down to the screen, we can see that their market capitalization coming in $114.5 billion and their revenue is at $52.4 billion. The PE ratio coming in at 14.9. Now guys, normally I like companies with a PE ratio of 20 or below. So having 14.9, that is a go for me. So I like it. But at the same time guys, when you see a stock with a high PE ratio, what does it tell us? Well, it tells us the market cap expectation of the stock is high, and therefore we might see capital gains on those stocks because there's a lot of investors coming in and pushing the price even higher because they're expecting better and better numbers. But the overhanging risk is if the company cannot meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks because the market doesn't expect much from those stocks. So having a PE ratio of 14.9, I like it. Now profit margin coming in at 11.5%. I like companies with a profit margin of 15% or higher. So 11.5, that is just too low for me. So that is a no. Price to sales ratio coming in at 2.1. Normally I like companies with a price to sales ratio of maximum 4. So coming in at 2.1, that is within my range. So that is a go. Now price to book value is at 6. Normally I like companies with a price to book value of maximum 3. So coming in at 6, that is too high for me. So if we were to summarize, PE ratio within the range, price to sales ratio also within the range, but price to book value is too high, making the company overvalued. Now they pay out a dividend of $1.74. I like it because I like those recurrent income. So that is a plus. Effective return coming in at 4.4%. I like it. So that is a good value. Now guys, I want you guys to be very cautious because I don't want you to jump the gun just because you see a stock with a high effective return, because that could be a trap, meaning that you make a good return as long as you hold that stock, but when it comes time for you to exit the stock, you might not get a higher price than what you bought it for. So make sure to ask yourself, is this stock consolidating? Is it moving in a negative trend channel or positive trend channel? What is my exit strategy, and will this trend change when I want to exit the stock? So be very cautious here. Don't just jump the gun because you see a stock with a high effective return. Return on equity, these numbers is out of line, but I believe is 37%, and that is a go. I like it. Basically, return on equity tells you about a company's ability to create return on their equity, and as for investor, you want to have a company with a positive return on equity because that is telling you that the company is able to create return on the capital you're about to invest in them. So 37%, I like it. Return on asset coming in at 8.4%, a bit low. I would like to see at least 10% or higher. So coming in at 8.4%, that is too low for me. So that is a no. So the stock is currently traded at $44 per share, and if we go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. So the indicator is telling us that we might see the stock price decline. If we take a quick glance on the chart, we can see that we have been moving in a negative trend channel for quite some time, but as of lately broke out of that channel, and as of lately what we can see here is that we are potentially seeing a counter trend formation. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement. And what we can see here is that the total revenue went from $53.7 billion in 2017 and went down to $52.4 billion in 2021. And we can see that these numbers have been fluctuating, but overall trend is positive. Gross profit went from $23.2 billion in went down to $22.2 billion. And also here, not a lot of changes. So more or less a stagnated development. So that is negative. Net income went from $6.1 billion down to $6 billion. We can see that it improved a bit, perhaps in lower and lower numbers, and then improved again in 2021. So that is a plus. If we go over to the balance sheet, and what we're interested here is that the current assets versus the current liabilities, and we can see there's a huge difference between the current assets and the current liabilities. Basically what this is telling us is that if the company were to convert their current assets to cash, they are not able to pay off the current liabilities, and that is negative, and they are far from being able to pay off the total liabilities, which is also negative. But if we take a closer look at the total liabilities, we can see it went from $45.9 billion up to $55.3 billion, and these numbers have been growing. They paid off a bit in 2020, but the trend, we can see that the numbers are growing every year, so that is negative. I would like to see them continue to try to reduce their total liabilities and also the rate which the total liabilities are growing. But if we take a closer look at the number of outstanding share, we can see that it went from $2.8 billion, 2.8 billion shares down to 2.6, and we have seen over the last 5 years that these numbers have been declining, so that is a plus. Basically what is happening here is that when you see the number of outstanding share decline, that means that the company is doing buybacks, meaning that there are fewer and fewer available shares out there, making your share of the company grow. But if we were to see this number increase, that would mean that the company is issuing more and more shares, meaning that there are more and more available shares out there, making your share of the company decrease, meaning that you're being diluted as investor. And there's a lot of investors that either skip this part or doesn't know about it, because they've been looking at a company's balance sheet and they see a company, for instance, that has a lot of assets and the debt is not growing that much, which is great, which is positive, which is what we are looking for. But on the other hand, we can see that the company is issuing more and more shares, which is negative. But at the same time, that's a way for a company to bring in more capital without taking on more debt. So make sure when you look at a balance sheet, don't get stuck on the assets and the debt. Make sure to also look at the number of outstanding shares. Now let's jump over to the cash flow. What we are interested in here is that the operating cash flow versus the capital expenditure. We can see here the operating cash flow came in at $8 billion and the capital expenditure at $1.2 billion, making a difference of $6.8 billion, which is a plus. We can see that the operating cash flow went from $7.3 billion up to $8 billion, and we fell off a bit, but has seen better and better numbers. We fell off a bit again in 2021, but overall trend is positive. Capital expenditure, we can see here, went from $1.7 billion down to $1.2 billion, and these numbers are more or less stagnated, but has of lately seen a reduction in investment. That is negative. I like that the operating cash flow is improving, but I would like also to see that they continue to invest in the business. Sure, they're doing that, but they have reduced the amount of capital which is allocated to their capital investment, so that is negative. Now let's jump over to our key figures, and what we can see here is that the earnings per share went from $2.1 per share up to $2.3 per share, and these numbers have been improving. We fell off a bit in 2019, 2020, but have since in 2021 improved those numbers. That is a plus. Revenue per share went from $19 per share up to $19.9 per share. We can see here we fell off, but has since seen better and better numbers, so that is a plus. Equity per share went from $4.8 per share up to $6.5 per share, and we fell off in 2018, but have since seen better and better numbers, so that is a plus. Dividend per share went from $1.3 per share up to $1.7 per share, and these numbers have been growing every year. That is a plus, because I like those recurring income, also the fact that the income is growing every year, so that is a plus. Dividend payout share went from 64, a bit of fluctuation here, 43, 74, 76, 74. This is negative, because I like companies that pays out less than 60% of their capital, because I want some of the capital to remain in the business for investments, for acquisitions, and just overall strengthen their business for uncertainties. So seeing that they are above 60%, that is negative. Gross margin went from 43% down to 42.3%, and we can see that these numbers improved a bit, but have since seen lower and lower numbers. This is negative. Basically what is happening here is that the gross margin, the cost of goods sold is increasing, and the company needs to find ways to become more efficient. But at the same time, we need to compare these numbers across the industry and see how is the company doing compared to the competitors. Operating margin went from 15% up to 16.3%, and these numbers we improved, but have since in lower and lower numbers, and we saw here a small improvement in 2021, so that is a plus. Profit margin went from 11.2% up to 11.5%. Same trend here. We saw that these we increased, but have since seen lower numbers, but as of lately seen better and better numbers, so that is a plus. Return on equity, as I mentioned, tells you about a company's financial ability to create return on their equity, and seeing that they went from 44.4% down to 35.3%, and we've improved a bit, but have since seen lower and lower numbers. That is negative. Return on asset went from 10% down to 8%, and we can see same trend here. We saw better numbers, but have since seen lower and lower numbers. That is negative. Solidity tells you about a company's financial strength for the long term, and we can see it went from 22.6% up to 22.7%, and we can see here the numbers have been improving. That is plus. Balance sheet liquidity went from 0.75 down to 0.57, and these numbers have been getting lower and lower, so that is negative. Debt ratio went from 3.37 down to 3.24. We saw they increased these numbers, but have since seen lower and lower numbers, and that is a plus. Basically, in 2021, they had a debt ratio of 3.2, meaning that they had 3.2 times more debt than equity. But seeing that these numbers are decreasing, that is a plus. So guys, we have gone through the income statement, balance sheet, cash flow, key figures, and now over to our key features, which is the stock analyzer. And what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we take a look at the screen, we can see that the PE ratio is below 20, which is positive. The company pays out a dividend, which is positive. The dividend payout share is greater than 60%, that is negative. Dividends have increased over the past 5 years, positive. Number of outstanding shares have decreased, that is positive. The revenue decreased over the past 5 years, that is negative. And the profit margin is less than 15%, negative. And the profit decreased over the past 5 years, negative. And the current assets are greater than less than current liabilities, negative. And the solidity have improved over the past 5 years, that is positive. And balance sheet liquidity have decreased over the past 5 years, negative. And debt equity ratio have improved over the past 5 years, positive, and the total liabilities have grown over the past 5 years, that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you, and it saves you a lot of time. You can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to commerce.se and become a member today. Okay, thank you so much. But now let's take a look at the technical aspect of the stock. So guys, here we have the chart. As you can see clearly that we are moving within the positive trend channel. I've been doing that for quite some time, but as of lately seen the stock price hit a ceiling and now have returned back within the trend channel. And what we are right now at $44 per share, we can see that these are key area here. As you can see that this support line have held a couple of times, so this is a key area we are witnessing right here. So what we could see is that I believe there will be a lot of buyers entering here for a potential push upwards the resistance level, and we could see a potential price move of, let me see here, 40%, 25%, 40%, something like that, price move we could see here. So I think there's a lot of investors that will be buying here. But sure, we have uncertainties in the markets. We could see a bumpy ride ahead of us, so we could perhaps see the price go down below the support line and towards this area right here. And this area to me is very attractive. So whenever the stock breaks below this area, I'm buying, because I will be dollar cost averaging, and that's a way to trade the stock, is buy over here for a potential price move, or have the price go back down because of the uncertainties in the market, and just hold the stock and wait it for whenever the trend changes, and you could be earning capital gains and dividends along the way. So that is a way to trade the stock. So if I were to summarize my thoughts about the company, well, looking at the numbers, we can clearly see that the business have more or less stagnated. The revenue and net income is not moving, the debt continues to grow, and they are far from being able to even pay off their current liabilities. They have reduced the amount of capital that is allocated to capital expenditure, but I do like the fact that the operating cash flow is improving. But what I would like to see is that they cut their stock repurchase program, reduce their dividend payout ratio from 70% down to between 20 to 30%, and use some of the capital to reduce their debt and invest in their operations, because the gross margin is declining, return on equity and on assets needs improvement, but also their finance for uncertainties needs improvement. So the question we're all asking ourselves, should we be buying? Well, looking at the numbers, I don't find much that attracts me besides it being a stable company that pays out dividends which are growing year over year. Luckily, the stock price are within a positive trend line, but otherwise I don't have a strong compelling reason to buy the stock. Seeing the stock move back within the trend channel makes it very interesting to look at. We could see if we were to buy the stock around $43, $44 per share, we could see the price move back up to around $60 per share, giving us a 30% price move. But as always, nothing is for certain. The climate short term consists of a lot of challenges ranging from high inflation rates, potential recession, increase in interest rates, and Unilever has a lot of debt. And we are already seeing a lower consumer confidence due to high inflation. But at the same time, we are seeing a lower unemployment rate. US job vacancies are dropping, meaning that companies are finding workers and the labor market participation is improving. So there's a lot of uncertainties, and therefore short term we could have a bumpy ride ahead of us, and we could see the stock break below the $44 support line. If that would happen, then I would be very interested in buying the stock and hold for a couple of years in order to earn dividends and capital gains. So if I would score the company, I would give them a score of 50%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below, and also let me know if you have any questions or have stocks you want me to look at. And as always, please do your own analysis. Thank you so much for watching. I am truly grateful and I appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe, and until next time guys, take care. Bye bye.